Cashflow Diary Podcast, episode 548.
Welcome to yet another exciting episode of the CashFlow Diary Podcast, the podcast that teaches you insider tips, tactics, and strategies for creating leverage streams of cash flow into your life. Learn from top-performing entrepreneurs, business owners, investors, and thought leaders from across the globe as they share their secrets to success. Like what you learn on this and other CashFlow Diary podcast episodes? Go to learninvestingnow.com and sign up to receive powerful tips and information that will help you succeed as an entrepreneur and investor. Now, here's your host, investor, entrepreneur, business owner, educator, speaker, author, and master facilitator of Robert Kiyosaki's cash flow game, Jay Massey.
All right, ladies and gentlemen, welcome to another episode of the Cashflow Diary Podcast. I'm your host, Jay Massey, and I'm glad that you are here today because we are going to talk about something that, honestly, I get asked all the time. And more importantly, many of you, I know you are dealing with this question. Here's what I mean. You woke up, you had a great idea, and you got started. And now maybe you're trying to figure out, how do I bring this all together? How do I get all of the resources that I need? And how on earth do I raise capital? Do I bring people on board? And if I bring people on board, what on earth do I give them? How much of my company what do I do? Is it equity? Is it debt? And all of those things and more is exactly what we are going to talk about. I have with me today none other than Mike Moyer. He is the author of best-selling books like Slicing Pie, Fund Your Company Without Funds. Gets exciting already. And he also has a book called Bird's Eye Business. Now, here's the thing I want to say to you guys. I want you to pay attention to all of the details. If for some reason you find yourself having to listen to this particular episode multiple times, that's probably going to be a normal thing. Because we have with us in Mike what I love to call the player coach, meaning someone who has been on the court, in the game, and scored points, and is also teaching others of us to play the same game. Because he is also a professor and has been teaching at Northwestern as well as the University of Chicago, which means we have a lot to learn. So put the dishes aside. You can walk the dog later. So let's get ready to listen, learn, and take notes from Mike Moyer. Mike, how you doing?
Good. Thanks for the nice introduction.
I'm glad that you're here. I am eager to ask you all kinds of questions because you'll make my job ultimately easier because I think fundamentally you and I are coming from the same place. So I'm really excited to get started. However,
I love this topic. I love it.
I can only imagine. It's like your entire world. So this is going to be great. But before we go there, I have to ask because this is the first time you've been here, I have to ask the same question I tend to ask everybody the first time that they're here. You ready?
Yep.
All right. I tend to look at today's entrepreneurs a lot like yesterday's superheroes. You know, Batman and Robin, Superman, Spider-Man, Hulk, etc. You get the idea. Because I think superheroes and entrepreneurs have a ton of things in common. For example, as an entrepreneur, I can occasionally envision myself flying around town using our products one sale at a time to save customers. And at the same time, as an superhero, you know, entrepreneurs have a beginning, superheroes have a beginning, like Spider-Man. There was a time where he was just a kid going to school, doing his thing, not paying attention to much. One day he gets bit by a spider, discovers I have a superhuman ability, and now he gets to choose whether to use it for good or for evil. So my question to you is as follows. Before Slicing Pie, before Bird's Eye Business, before teaching, before all of the companies and entrepreneurs that you have consulted with, the businesses you've been a part of, before everything we know you for today, what we want to know is, who is Mike Moyer?
You want the origin story?
I do.
Entrepreneurship. I love this analogy. I got the entrepreneurship bug when I was in high school. I was really into animals, wanted to be a veterinarian, and I used to raise rabbits and pigeons and geese and all kinds of things in my yard. And I had some rabbits, and I tried to breed them for years, and it never worked. And then one day it worked, with a vengeance. I had 25 baby rabbits all of a sudden appear on the scene, and I didn't know how to get rid of them all. And my aunt said, there's an art fair going on down the street. Why don't you take a box of them down there and sell them? Don't give them away. Sell them for $25 each. This was back in the in the 80s. $25 is a lot of money. It still is for a rabbit. And I sold 24 baby rabbits for $25 each in about an hour.
Wow.
And the next day, someone came and bought the last one. I couldn't give them to anybody beforehand, but I could sell them for $25. And I realized that it was so much fun to create something, these cute little pets, and sell them for was probably twice what they were selling in the pet store for. And from then on, I just kind of stopped my own way for the most part. And in college, I started my own company, T-shirts and clothing manufacturing. And then I went back and forth between startup and established company over the past 15, 20 years to where I am today.
Okay. I just want to make sure I heard something correct. Did you say pigeons? How did okay, I'm trying to imagine that idea of pigeons. Because you said, if I heard you correctly, you said rabbits, pigeons, and geese.
Rabbits, pigeons, and geese. Yeah, pigeons are an unusual hobby for a kid. For sure. Mostly old men do them. But I've had a friend who lived a few towns away from me, and we were going to see each other so much. His dad jokingly said, "You guys should get homing pigeons and trade messages." And he never did it, but I kind of got into the hobby, and I had about 25 or 30 different homing pigeons, and I could take them around to anywhere I wanted. They'd fly back home. I trained them to come back home. I actually wrote a book about this too. I wrote a book about college admissions, and it included the story about taking pigeons to college admissions office interviews and letting them go, and that was a big standout for me in my college admissions process.
Okay, I like it. All right. So, and now I'm assuming then there was a detour from being a vet somewhere in this process. So
called terrible grades.
Got it. I was like, what, where did that come from? So then that pivots into clothing and T-shirts?
Yeah, my parents decided that if I was going to get bad grades, they weren't going to pay for my college. And they told me to come back and get a job. But instead of doing that, I started a T-shirt company making T-shirts for sorority houses. And I was my own illustrator and built that business up, and then invested in some manufacturing equipment and started making jackets and clothing myself. I ran the business for about 5 years through graduate school, my first round of graduate school, and I sold that company after I graduated.
Interesting. So your businesses paid for your schooling is what I'm hearing.
Yes. 100% of my college education is paid for by my own job.
Okay, so this sounds interesting because it sounds like you've always had your foot in, we'll call it both worlds, because there's a number of people who subscribe to the idea that if I'm going to do a business, college has, a less of an impact, and less of a need yet. And then there's also the individual who's like, man, college and education, this is everything. I want 12 degrees and all this other stuff, to the exclusion of actually going out there and practice. Where does it's just almost like a split personality thing going on. How does that work?
I certainly value both education and practical experience. I actually have 3 degrees, one from undergraduate, one from Northwestern, and one from University of Chicago. And I value the education because it saves a lot of time when you're doing your own work, doing practical work. But I also value going to work for real companies for some time to learn. So I spent my career going back and forth between real company and startup companies. Not only after some losses, I had to go back and get real jobs from time to time, but mostly to learn about the business and what I do. One of my companies today is a manufacturing company that makes mosquito net tents. And I learned a lot about manufacturing when I did my own manufacturing, but also worked for a company that manufactured overseas. So I learned a lot about manufacturing overseas. So using those skills, it makes it a much faster learning curve for me to do my own business that way. So I definitely value going back and forth to real jobs, education, and startups.
Now, you've said this a couple of times, that you've used the phrase real jobs, real companies, and going back and forth to being startups. What is the distinction there that you're making?
A real job is one where you go and you get paid. And that's pretty much it. A startup is one where you're creating something from scratch for the most part, but you're not getting paid in the sense that your future is unknowable. You're taking risk. I think of we think of startups, bootstrap startups, as assets. We think of startup companies as assets. A company isn't an asset until it starts producing cash. Before that point, it's a startup. A startup is a gamble, pure and simple. It's just a bet. So when you contribute to a startup and you're not getting paid, you're basically gambling on the future outcome of the company. That's what I think of when I think of a startup. You're gambling your own money, and there's a chance of losing it, either in the form of time or resources or cash.
By that definition, companies like Uber still qualify as a startup.
And they're still pretty big gambles.
When you're saying it, I was just thinking and applying it to some of the larger companies that come to mind. I'm like, yeah, I would agree with that. Now,
it's a startup, but it does have cash, and in the sense that it has plenty of investment dollars. People who work for Uber get paid to work for Uber. They're not risking themselves necessarily.
No, yeah, true, but it's not like the company in it. I interpreted your statement to mean the company was actually throwing off free cash flow after expenses, not necessarily paying people out of investor dollars or something of that nature.
Yeah, that's a good distinction. I consider startups that don't the ones that I deal with in my world are bootstrap startups. These are the ones that don't have cash either through break-even revenue or Series A investment.
All right, this is perfect then, because this is the world that the CashFlow Diary student lives in. This is the person that's listening, and we have a ton of them out there because we all wake up occasionally with that idea. We get started, and then we're like, well, how do I keep this going? And how do I have a foot in both worlds? What has been, in your estimation, the best way to do that process and go through it?
Well, the question that you just mentioned, the question they're asking themselves is, how do I get started without any money?
Yes.
How do I pay for all the stuff that I need?
Yep.
And the answer is, in a bootstrap company, you don't pay it. So the way you finance yourself in the early days is by not paying for things. Most companies expect to pay, people expect them to pay their bills. So if you send my company a bill, for instance, you expect me to pay it. If you work for me, you expect to get paid. If you work for most companies, you expect to get paid. This is a basic expectation that companies pay their bills. But startups, for whatever reason, just are off the hook for that. So when someone contributes to a startup and is not paid, it doesn't mean they're not worth the money. It just means you didn't pay them the money. And the amount you didn't pay them is what you otherwise would have paid them. So if you're worth $100,000 a year to me as a marketing executive, and I don't pay you $100,000 a year, you're essentially betting your $100,000 a year salary on the future of my company. Does that make sense?
Yes, I follow the rationale.
So the best analogy I use is blackjack. Do you know how to play blackjack?
I do. It's actually one of the few card games I'm willing to play.
It's a good one. So let's pretend that you and I are going to go play blackjack together as a team. Not as opponents, but as a team.
Okay.
And we're going to agree to split the winnings 50-50.
Okay.
So we go to Las Vegas. We each put $1 on the same hand of blackjack. We don't know if we're going to win. We don't know how much we're going to win. We don't know how long it's going to take to win. All we know for sure is that we each bet $1. So
yes.
The dealer deals 2 aces. So what are you doing with 2 aces in blackjack?
That's a double down situation.
Let him double down for sure. So I'm out of cash and you're not, so you put $2 more down. So now you've bet $3 and I bet $1. We still don't know if we're going to win or how much we're going to win or how long it's going to take to win. The future is still unknowable. What we know for certain is that you bet $3 and I bet $1. If we win, does 50-50 sound fair?
No.
Could be what?
Not 50-50.
75-25. Right?
Sure. Yes, I see where you're coming from there.
So that's a logical, obvious, and unambiguous outcome. That your share of the winnings should be based on your share of the bets.
Yes, but that doesn't... Go ahead. This is good. I have objections to the idea. Yeah, got it. No,
when you contribute to a startup and you're not paid, your contribution is a bet. And it's exactly the same thing. You're betting time and money and ideas and facilities and supplies and equipment and relationships. You're betting all kinds of things. The fair market value of those things that you're contributing is your bet. So your share of the equity should be based on your share of the bets.
Got it. But so with that in mind, here's one of the challenges that I'm thinking about is in the early stages of, everything, there's often a need for, continuous capital after that. It is always, historically anyway, felt like the entrepreneur gives up way too much for just not knowing what their idea is worth, what they're ultimately building is actually going to be valued at or could be valued at.
Right. We can't know that. It's an impossible thing to know. We can predict it, and people try all the time. But just like we can't know the outcome of blackjack, we can't know the value of our idea. So all we can know for sure is the bets. And I can't say that I'm a magic super fairy because I had an idea, and you're not magic because you don't have the idea. All I can do is place bets on my idea. My idea to play blackjack, I could say, hey, let's go play blackjack. We're going to win $1 million. And you can say, well, maybe we'll win $1 million. You might win $10. You don't know. You don't know. So my idea of playing blackjack has no value. All that has value is the bets that I place on it.
Interesting. But wouldn't you say, I mean, I would come from the standpoint in this thought process of thinking that the idea, capital to me anyway, and maybe this is my skewed perspective, but capital to me feels like it is the oversupplied commodity. The idea is one thing, but also being able to execute is another. And someone who has the ability to execute with a great idea seems to be a harder find, and therefore the greater value. But that's not what you're saying.
Well, in the early days, for most bootstrap companies, capital is not oversupplied. That's the scarce commodity. If it wasn't scarce, I could just pay everybody and keep all the equity for myself.
Got it. I was saying scarce in the sense of in the grand scheme of the entire globe/world, there's more of it that's there. And it seems to me to become a matter of marketing the idea to help people understand that this is where you're going, not necessarily. I get that we may not be able to attract capital at the early stage, but it doesn't mean it's not present, does it? Hello there, entrepreneur. This is Jay Massey, and what I want to say to you is that the number one mistake that I have ever made in business, number one, has been waiting too long to do the books, waiting too long to get the bookkeepers, the accountants, the CPAs, the CFOs involved, and I don't want you to make that same mistake. That mistake cost me over 6 figures, and now for a significant discount, you have the ability to get your books together using FreshBooks. So what I want you to do is I want you to go over to gofreshbooks.com/cashflowdiary. Again, that's gofreshbooks.com/cashflowdiary. FreshBooks is the easy to use software designed to help you, the small business owner, the freelancer, get organized and save time on invoicing, getting paid faster, keeping those books in order so that it becomes a bonus for you to do your taxes as opposed to a burden. Go over to gofreshbooks.com/cashflowdiary and get started today. And now let's get back to the rest of the story.
What you're looking for is the production of value out of the idea. So the gamble is that I can produce value out of my idea. Mm-hmm. And so my value comes in the form of revenues, customers, intellectual property, things that are valuable in the sense that people will invest money into them. People think of ideas, they basically talk about their intentions. You're basically valuing your intention of doing something. No one gets paid on their intentions. If I intend to come to work for you, you don't give me my whole salary up front. You only give me money as I work for you. But an idea is simply an intention of doing something. If I do something, I create customers, or I create revenues, or I create intellectual property. If I actually create something that people want to acquire, then I can set a value for my company. And it's no longer a gamble. It's an asset because it has an ascertainable value. But in the beginning, the early days, there's no way I can attribute a value to my company. Just like you said, what's the value of my idea? It's just my intention. I can call it $1 million, but it's just me guessing. Founders are very bad at valuing their own companies because they're overly optimistic.
So what about the situations in which the person is, maybe it's while this company is new, that person themselves aren't necessarily new? Isn't there some weight there? Or, I mean, especially if they're working with with the idea that already has POC, I mean, I don't see why it seems like there would be just more weight there.
Sure, that would be reflected in our fair market value. So your fair market value for producing a radio show is higher than my fair market value for producing a radio show because you have more experience. So you might deserve $100,000 a year for your expertise. I might deserve $30,000 a year for my expertise.
So
If
how
you're a
does that
trained chef,
determine though? How do you guys how does the entrepreneur actually attract the person who's willing to play the game that way and come up with a value that makes sense?
the conversation is always the same. If I was going to pay you for your contribution, how much would I pay you? And people are much more accustomed to negotiating fair market price than they are to negotiating future value. If you were going to buy an iPad, how much would you pay for the iPad? If you were going to buy a glass of water, a bottle of water, how much would you pay?
Mm-hmm.
If you were going to hire a babysitter, how much would you pay? If you're going to hire an SEO person, how much would you pay? If you're going to hire a doctor, how much would you pay? People are very accustomed to negotiating fair market values. And so your experience and your education and your skills would determine your fair market value. If I paid you your fair market value, you wouldn't get any equity and you'd be perfectly happy because you're made whole. If I don't pay you fair market value, then the part that I don't pay you is your bet.
But okay, so and then how do we determine what, I guess, equity that's worth? Because it's got to be.
So the betting continues until it's no longer needed. So every day you show up to work, you're betting. So if you're worth $100,000 a year, every hour you work is worth about $50. So every hour you work is worth $50. You're betting and betting and betting. You buy a plane ticket, you're betting the cost of that plane ticket. You buy server space, you're betting the cost of that server space. And the betting continues until the company has enough money to pay you either through Series A or break even. Now, once you're getting paid, the pie bakes, and you can determine equity based on your share of the bets. So your share of the equity is always based on your share of the bets, just like in blackjack. It's the exact same thing, 75-25.
I see. Got it.
So take a real simple example. Let's say that we're each worth you're worth $100,000 a year, and I'm worth $50,000 a year. All we do is spend time on the project, nothing else. You work for 1 year, and I work for 1 year. You bet $100,000, and I bet $50,000. It would make sense that you would have 2/3 and I'd have 1/3 because our share of the bets reflects our share of the equity. It wouldn't be fair for 50-50 because you bet a lot more than I did.
Right. No, yeah. And that's, I guess that's kind of where I was coming from. So what you're saying is you're basically earning the equity on a well, not all up front, but as you go, and then you don't even determine that number until you get to some break even point, or what, how much cash that might actually be, or what percentage that is. And then at the point that cash is there, then you just get paid.
Exactly. You start getting paid. So I could tell you I'm a $50,000 a year developer, and you couldn't do your idea without me. You have to have me, but you could hire somebody else $50,000 and pay them $50,000 to do it. So I got to assume that I'm not a scarce commodity. Now, if Donald Trump wanted to slap his name on it, you might have to pay a little more for that. But for the most part, certain people are going to be funded immediately. But most of us aren't. So it's whatever we're risking. I can't say that because I'm a developer, I'm some kind of magical developer. I'm worth more than my fair market salary. I'm only worth my fair market salary.
Yeah, no, totally understood. And then when it comes down to actually putting this pen to paper to make that work, what type of an agreement is that?
Slicing pie agreements exist all over the world. I have lots of templates on my website. There's lawyers literally.
Of course you do. I'm like, I had never heard. Okay, got it. This is new.
It's a basic agreement that just outlines the rules. There's two parts of the model. Uh-huh. There's the allocation part, which determines how shares are granted using that betting model.
Yes.
There's the recovery part, the recovery framework or logic that determines what happens if you walk away from the company or you get fired.
Got it.
One risk for startup is we go in 50-50, you do all the work, and I own half your company. Now you got to sue me to get it back.
Right.
Or you got to pay me. There's all kinds of examples where the guy who flakes out early on is the only one who makes any money because they all buy him out because they think the company's an asset. So slicing pie logic also includes what happens if someone leaves a company.
So let me ask this question. What about the situation in which the operator, entrepreneur, they're contributing time, someone else is contributing just capital? How does that work?
So slicing pie uses a tool called a slice. A slice is like a poker chip. It simply marks the fact that a bet took place. And in the spirit of blackjack, if you win blackjack, you double your money usually. So for every dollar in non-cash you put in, you get 2 slices in the pie. Cash is a little bit different. Cash, we have to account for the fact that when people put cash in, it's usually after-tax dollars.
Mm-hmm.
There's a general scarcity of cash, and we want to provide incentive for the entrepreneur not to spend the cash. I'm a child of the dot-com bubble, and I remember spending lots of cash on unnecessary things like ski trips and expensive chairs and all kinds of stuff and pinball machine games. We want the entrepreneur to think twice before they spend the money. So in Slice of Pie, you get 4 slices for every dollar in cash you put in. So as cash is consumed, the person who contributed the cash gets 4 slices. As non-cash is consumed, the person who contributed the non-cash gets 2 slices per dollar. So your $100,000 a year salary would be marked as 200,000 slices, and my $50,000 cash investment would be marked as 200,000 slices because it's 4x, and that provides incentives and alignment for everyone participating.
Huh.
One of the major challenges people have is we'll go in 50-50. I'll put $50,000 cash up, and you put your time in.
Yeah.
So I just capped my exposure to $50,000, and I've given you incentive to spend all the money. So I've misaligned our interests. And now for the first day, that's great because you haven't done anything yet, and you got 50%. Half a year into it, we put in similar amounts. A year into it, you put $100,000 unpaid salary. I put $50,000 in. 2 years later, you're pretty pissed at me because you've gone 2 years with no salary, and I've just put in $50,000. So by setting a fixed split, a fixed amount in exchange for any amount of cash, you're misaligning the interests of the investors, and you're capping one person's exposure and leaving the other person unlimited.
Yeah.
Accounts for that by allocating slices over time.
Well,
and it only turns to equity when it's spent. So I can't overinvest in a company and just have cash sitting in the savings account. It's only consumed when it's at risk.
Well, so all right. Here's what's going through my head. So let me just sit this with you right here, because this is the challenge that I know a number of our students are facing, and the question they keep asking me. And here's the model. Here's what's happening. As we go out there to perform our business, we tend to focus in real estate, specifically short-term rentals. But we're not involving the acquisition of the property. So the property and its value are not a part of this equation under the scenario. We'll go rent the place and turn it into a short-term rental. That's basically the entire thing, what we do. What happens all the time, or often, is that the operator student has the time, effort, energy, knowledge. That's what we provide them so that they have the ability to do it. Now, in many cases, they're able to go ahead and build the business because it's a very low expense to get started, and because of that low expense and because of the high revenues, getting to a point to where you actually have operational cash flow can happen relatively quickly, say 45, 60 days. Okay. So in this particular example, person A wants to do it. Person B has, and I'm making up the number right now, but let's call it, you said 50,000 earlier. Great. $50,000. Person B contributes to $50,000, but person A is able to get, we'll say, 2 locations for that amount of money. Now, what's going to happen is that as soon as person A gets those 2 locations going, within about 60 days, they're going to be cash flow positive. How does it work in that situation? Because it sounds like it's too quick to be able to, for their effort and energy and time to earn enough slices.
Could be. There's a couple things going on there, and this is a market that I'm somewhat familiar with. I have fairly significant investment in vacation rentals properties.
Oh, awesome.
And so we have the manager who manages the rental and the cleanup and the keys and all that kind of stuff, and then the owner. And so you think of Slicing Pie as a financing tool for short-term liabilities. And a short-term liability is going to be someone's salary, someone's travel expenses, things that the company would owe but didn't have cash for. So in the scenario you just described, there's a cash contributor. So the financing of the building, all that kind of stuff, you set aside because you finance that differently. Mm-hmm. You finance it through loans. In fact, one thing that's always interesting to note as an aside is the only reason you use equity at all is because you don't think it's going to work. If you knew it was going to work, you'd use debt.
Right. And which is what I've been telling that. So that we're clear, the major structure that I have been a proponent of for myself myself and students has been debt, because I mean, we can pay it off really fast and all those other things. And it's been working, but yet there's still this question of how does it work? Because I think it gets lopsided later, because as soon as the operator then wants to go do 5 more locations, the person they went to for money the first time may not have it. And now they have this weird situation where, or they have to start a completely new entity or something. And now it gets complicated on an accounting standpoint to be able for them to make it work.
The unknown is the ability of the operator to scale the business.
Right.
So my kids run lemonade stands, and they buy some lemonade in cups, and they go out with their friends, and they sell lemonade, and they look in the jar, and they take what's left over and split it up. What they don't account for is their salaries, their hourly rate for working the idea, for working the business. So cash flow positive as they may be, they haven't taken out their expenses necessarily, and they haven't taken out their salaries. So in the scenario you described, the operator would be entitled to a salary. So you said $50,000 a year. So person A puts in $50,000 cash. That cash is consumed acquiring licenses to rent properties or acquiring properties.
It'll be spent inside of 3 weeks, all of it.
So it's consumed. So that person gets 200,000 slices, right? In my model. And the operator spent, let's call it $60,000 a year, it's easier to calculate.
Sure.
Spent 2 months setting it all up.
Sure.
So that person risked $5,000 a month.
Okay.
$10,000 total, or 20,000 slices. So that person now owns the business 200,000 slices to 20,000 slices, so about 9%.
Yep.
And then that person starts collecting a salary. Well, that person's risk is no longer on the table. The risk, he's no longer taking any risk, so that person owns 10% of the company. So if I'm getting a salary for doing something I love, I'm in a good job as long as I'm getting a fair market salary. So theoretically, I could hire the operator and just pay him a salary and keep all the equity for myself. As long as I'm paying a fair market salary, that operator should be happy. But the operator, if he's not getting paid a fair market salary, or she's not getting paid a fair market salary, she won't be happy.
Right.
I gotta make sure I'm paying a fair market salary. So if I don't pay you a fair market salary, that's considered a bet, and you get accounted for that in slicing pie. If it is, then you would, if you are paid a salary, then there's no slices. So the ways that the operator might handle that situation is to finance the cash differently. So I might put the cash on my credit card, for instance, or I might do a short-term loan for the cash or something else. But if I'm taking it as equity, that implies that I may never pay it back if I fail. We may lose it, and in that case, it's a bet. I can't call my bet different than your bet just because I want to. My bet's a bet, just like your bet's a bet. So going back to the blackjack table,
got it.
I can say it was my idea to play blackjack, so I should get my 50%. Right. You look at that deal and say, that's not fair. I clearly bet 75% of the bet, so I should get 75% of the winnings.
Okay, so what happens in the situation when 3 months hence, so the operation is going into doing what it does, and now the operator, not the person who gave the original capital, the operator wants to add five more locations and needs another, we'll call it $100,000. So
at that point, they would choose to finance that $100,000 as most conservative as they can. If it's only an equity, all they can do is do equity, and then there's $100,000 would get 400,000 slices. The original investor would have 200,000 slices, and the operator would have about 30,000 slices. So the cash investors are taking a lot more risk once it's consumed. In real estate, you're dealing with fairly known entities, which is why it's sometimes hard to get your head around. Usually you want to do debt financing on real estate.
Oh,
when you're doing
agree.
equity financing. Yeah, when you're doing equity financing, the cash is what matters.
Yeah. I agree. That's it's interesting. So in the situation, you said something earlier. You said that it's a financing strategy for a short-term liability. Can you expound upon that for a little minute?
So a short-term liability would be like our salaries, our rent, our advisors, our lawyers, expenses that we would incur along the way that we can't pay. So because we can't pay them, we have no cash, we don't pay them. And a lot of startups, people just say, don't pay me, who cares? But in the slicing pie model, we say that the amount that I didn't pay you, I got your bill, Mr. Lawyer, I got your bill, landlord. I can't pay it, so I'm going to count it as slices in my pie as a bet instead of paying you. And that becomes part of the acquisition. So it's my risk relative to everybody else's. So if I don't pay you rent, that's a non-cash contribution. So if it's $1,000 a month rent and I don't pay you, you get 2,000 slices a month in my pie. And when I can pay you, I'll start paying you, and your bets will stop coming in.
So, you've created agreements for vendors to be able to read that and make that work?
Yeah.
Huh.
It's all the same deal. The beauty of slicing pie is that it's a universal one-size-fits-all model for the allocation and recovery of equity. That means anywhere in the entire world, anyone can use the exact same model and always get the same result. What's interesting about fairness is there are not multiple versions of fairness. It's either fair or it's not. At the blackjack table, my version of fairness has to be the same as your version of fairness, and 75-25 is the only solution. Let's say our dad gives a cookie to us. Says, split it up, boys. There's only one way to split that cookie fairly, right?
Sure.
50-50. Now, you can be really generous and give me your half,
Sure.
but your generosity doesn't make it more fair.
I understand.
I could be greedy and take your half, and my greediness doesn't make it more fair. What's fair is 50-50. You can do whatever you want with your half, but the fair solution is there's only one solution of it. In startups, when we do what's called a fixed split, when you split equity at the outset, it's anyone's guess what the future is going to hold. So anyway, so the fairness has a number of different ways of people think there's different versions of fairness. There's only one version of fairness. It should always reflect the bets on the table.
Interesting. So, and in order in a situation in which the entrepreneur is going out there to build his or her company, the only way for them to even come close to earning the same number of slices, say, as cash is either through honestly putting their own cash in or a significant amount of time, which leads me to how is the time allocated exactly? Like it's not like they're clocking in or something, or are they?
Well, you would think about how you pay a manager. Our managers, we pay a percentage of the deal of the rent. So the fair market way of paying an operator in many cases is a percentage of the rent that comes in. Is that consistent with your experience?
Well, no, because what we as the operator, we're not just managing it on behalf of someone else. So we are creating a company that does corporate housing or short-term rentals. So we're not doing it as a service for other people. And I think that might be where I'm having a disconnect.
So the way you pay someone in the real world, in a non-startup world, is the same way you pay someone in slicing pie. So if you pay an hourly rate, you would pay an hourly rate in slicing pie. If you pay a weekly salary, then you pay a weekly salary. So how you would normally compensate someone is how you compensate them in slicing pie.
Got it. But at the beginning, because I only have 1 or 2 units, I'm really not earning a full salary would be. And once I got, to 30, 40, 50 bedrooms in operation, obviously, if I've self-funded, I'm earning a significant amount of money at that particular point in time.
Right. So you would, in the early days, you have a lot of hustle getting new properties, though. So the management of your existing properties is small, but the hustle to go get new properties is big, isn't it?
Oh, I think I'm always in the hustle for more properties.
So shift from acquiring new properties to managing the existing properties. But once your salary is being paid on a go-forward basis, then what's left over is profit. And the company can take that profit and reinvest it in the company and buy new properties for that, or it can distribute to shareholders. And when you distribute to shareholders, you slice the pie will tell you how much each person gets, just like in blackjack paying off. That's the payoff, is the profit.
Got it. But we still have the limit. So then in this particular model, the limiting factor, or I guess the original contributor can still be a limiting factor because for example, if they don't want to allow another third party for expansion purposes, or they don't want to contribute more capital, then my growth is stunted. Yes?
Sort of.
Okay.
If you give your investor legal power to block another investor, that creates kind of a conflict if you want to grow. There's certain legal structures that would allow you to make decisions on behalf of the firm. Like a manager managed LLC, for instance, would give the operator more decision-making power
Mm-hmm.
than the investor. But technically speaking, the person who has the most risk on the table can make the most decisions.
Interesting.
But in
But
that
what
case,
if, but
you want to know up front that we might add other additional properties. You know, the manager, the cash investor shouldn't be upset that they're getting diluted down because the value of their bet is still represented properly.
got it.
If I bet $50,000 and you bet $950,000, I'm not uncomfortable having 5% because my 5% represents 5% of the whole.
Understood. Totally
Am I not?
understood.
I might want to keep more than my fair share, which is understandable, but that doesn't mean it's fair. You know, once you're faced with fairness, then the only thing you have to operating for yourself is your ability to be a jerk. You know, once I see what's fair, then I can choose to be a jerk or not.
Understood. Understood. Now, when it comes down to it, though, one of the things that's going through my head at this moment is the person who's doing the operating, even though the decision making, like you're referring to, can be in the hands of the person with more slices, but the person who knows what to do, what equipment to buy, how to actually make the thing work, I would argue that they're the ones who should have the decision power.
And that could be the case. You can do that contractually. And that would be something you would want to set up up front with your investors.
Got it.
But your fair market value assumes that no matter how smart you are, you're replaceable. So if you as the operator aren't a good operator, you can be replaced with someone with a similar skill set.
Got it. And is there at some point in this model where the operator, should they choose, have the capacity or desire to pay off the original investors, the others with slices? Is that a thing? Is that possible?
So that's called a lump sum payment.
Mm-hmm.
If the investor chose to have a lump sum payment, they could pay the investor back, and that would buy down the number of slices. You're not buying slices; it just reduces the person's risk.
Well, I guess the where I'm coming to is that by that point, the entire entity or the corporation would have a different valuation of some kind. How is that determined?
If the company has a valuation that's concrete, either through like a VC investment or a 409A valuation by an accountant,
Mm-hmm.
if it's a concrete valuation, then the buyout price would be set by the valuation.
Got it. So the slices are only there to help determine ownership until the point that there's either a valuation or cash flow.
Yes, they're just like poker chips. They're not worth anything on the table. They're just worthless things. They just keep track of the bets.
Got it. And how did you come up with this?
Well, you know, I've been through so many deals where I've gotten taken advantage of, and I've been on deals where I've been on the receiving end of it too. My first company I started, I did all on cash flow. I was petrified of how to do the splits. I had people want to join my company, want half the company. I'd say, for 6 years I've been building this company, and you want half of it? That just didn't make any sense. And I never got good answers from advisors and professors. They always gave me this kind of nebulous, equal splits are the most common, or based on future events. And I just sat down one day and wrote a list of criteria of what an equity split should accomplish. It had to be fair, has to reflect actual contributions people make. People make so many promises. Everyone's bright-eyed and bushy-tailed at the beginning of a startup. They all think they're going to do all kinds of things. Even myself today, I thought I was getting more done today than I probably will, right?
Mm-hmm.
So you can't value someone's intentions. You can't value things that don't happen yet. You can only value what's being valued. And the only thing someone's contributing is what they would have otherwise been paid. So these number of factors, just kind of thinking through the problem, kind of came up with the solution. I started a company years ago where I used an early version of slicing pie without the multipliers for the cash and non-cash. And people kept drawing cash from my savings account, from me. This is, if they're not getting additional equity for giving cash, they might as well not do it. So I spent all my life savings on the company because I wanted to succeed so much. So without those multipliers, they were indifferent to cash or non-cash. So I just wound up spending all my money. And I also had somebody send me a bill for the time they spent even though I told them they weren't going to get paid. So through trial and error, I kind of came up with this. And occasionally someone will say, hey, I had an idea similar to this using contributions, but it wasn't quite as fleshed out. I don't think there's a person on this planet who has put more time and energy into this problem than I have. I spent all my time thinking about it, and it just sort of come together. There's certain principles, like there's aren't multiple versions of fairness, for instance, that once you realize that's true, you got to uncover what that version of fairness is. Thinking about it in terms of bets, once you accept that's true, then you'll think about things in terms of bets. So all these things kind of came together over a number of years. But the first model came out, the first version I published in 2010. And I wrote the book in 2012, the first book, and the second book in 2015. And it's been translated into 12 different languages. It's been used all over the world by thousands of entrepreneurs. Not once have I heard of it backfiring. Lawyers that I talk to tell me that the traditional equity splits fail at a rate 60 to 80% and wind up in dispute that requires legal intervention, which means if you do a traditional equity split, chances are better than not that you're going to wind up fighting with your co-founders.
Exactly.
But Slicing Pie never fails. It always gives you the right answer.
So, okay. I guess the question comes to mind because I think I heard you hint at this. A company that's already in existence and maybe doing operations today could use this to bring on additional capital, could it not?
Well, sort of. If the company's in operations today,
yeah,
then they have a value.
Mm-hmm.
So a company that has a value is producing something of value, cash, it's producing revenues or profits or intellectual property or customers. So it becomes an asset. Before that day dawns, your company is just a gamble. When there's unknowable contributions to reach cash flow positive or break even or Series A, when there's unknowns there, then it's not an asset. It's a gamble. So it's a shift that a startup makes from being an asset, from being a gamble to an asset. Once it's an asset, I can set a price and sell shares for that price.
Got it. Okay. Well, and then let me ask this: in the instance when it is still in the stage of gamble, are you trying to account for what could become that future growth, those future expenses, that future salary that's needed? Like, because when I'm thinking about number of locations, they may start out with 2, but they could end up at 30. And sure. At what point are we talking that the bets, quote unquote, stop, so to speak, in that scenario, knowing that we're headed to 30? You
should always be projecting and do your financial analysis and do your projections and your market analysis. You're always thinking forward, like, where's the business going? But that's just your intention. So, a business plan is just an idea. It's just an intention of doing something. What actually happens is what matters. So I might say, hey, we're going to get 30 locations, and I might get 90 locations. Or I might say I'm going to get 30 and get 10 locations. You just never know what's actually going to happen. So until that day, till what actually happens, and you're in a position to pay everybody, the bets keep happening. Somebody told me once about an entrepreneur who set out to make $1 million, and he made $500,000. And another entrepreneur set out to make $1 million and made $10 million. Who's the better entrepreneur? The person who came closer to his projections, or the person who was totally wrong?
You
just never know. It's
hard
to say.
There's so many. Yeah, who knows? Who knows?
All you can, just like in blackjack, we don't know the future. All we know is the bets on the table.
Got it. I'm. Woo. Okay. So I'm sure it's common for you after you drop this on somebody that they go, okay, I'm gonna have to sit with this for a while and mull this over, because it fundamentally changes or makes available, or dare I say, unlocks opportunity in a completely different way. So for those that are listening and they want to find out more, what's going to be the best way for them to catch up with you?
Well, first let me say there's 3 reasons why someone wouldn't want to use Slicing Pie.
Okay.
The first reason is they don't get it.
Yes, okay, got it.
So you said they got to mull it over. And at my website, slicingpie.com, there's plenty of free resources. I got videos, I got free downloadable guides and spreadsheets and all kinds of things. I try to make the model as free as I possibly can. There's a blog content I'm always posting to. There's also things you can buy, of course, which are legal contracts and books, and there's software to help keep track. The second reason someone wouldn't want to use Slicing Pie is that they aren't willing to learn it. So you'll go to an investor and say, I just want 5% for my $50,000. It's just quote unquote easier. It's easier just to give someone a chunk of equity. What's hard is unwinding the problems that happen when you do. And the third reason is they do get it, but they still don't want to do it because they want to take advantage of you. And I see this very common. Someone will get the idea, but they'll still want 50,000 shares for their $10,000 or whatever, because their intention is they see your desperation, they want to take advantage of you. In those cases, I just say walk away. If your deal's a good one, you'll find another investor and another participant.
And that third scenario is what I have had to, for lack of a better way of putting it, felt like I've had to continually defend against in the world. And that's exactly that was part of my impetus for wanting to speak with you and understand this, is like, how do you help protect entrepreneurs from those types of things? But then I can hear it. And
sometimes walking away is your best option. I've done deals before where I haven't walked away and I've been burned royally.
All right. Totally understood. So I'm sorry, where did they go if they wanted to catch up?
Slicingpie.com is my website, and there's books and contracts, and there's even a software application called the Pie Slicer.
Yeah,
it helps you keep track of your slices in real time.
I like this a lot. I absolutely like what I'm hearing. Now, as we end, I have a final question for you, because I think you're going to give one of the most unique answers that we have ever gotten from this particular question. So I really want to know, because here's what I do know. I know that individuals who have been listening this far, individuals who have listened to this particular episode, they were in one place at the beginning and they're in a different one right now. And they're at what I like to call the precipice of decision. And often when we get to those points, as you know, we have a companion, and that companion comes in the form of a voice. And it's a voice that reminds us why it won't work, how it didn't work last time, and you're going to do what? And I've never heard of that. And all of those things. And for some people, they're related to that voice. So my question to you is as follows. Let's pretend that this time it's going to be different. This time, they're just going to do what you say. They're going to follow through, and they're going to do so in the next 24 to 48 hours. What would you suggest that they do?
To move forward with Slicing Pie?
They're trying to move their business forward. And it sounds like this is a way that many people are going to be able to make that happen. But they're all at various stages. What would you suggest that they do? Like, what's that immediate thing that they can do to have observable action and make something happen?
Well, the first thing I would do in this scenario, when I talk to startup companies, is figure out if you're getting what you deserve to get. If you're not getting what you deserve to get, you're working for somebody else, for someone else's benefit. If the equity split is not in balance, then I'm taking unnecessary risk to benefit somebody else. And you got to find out if you're doing that or not. And it's easy to figure out if you add up the contributions, you can figure out how badly you're getting screwed, in other words. And that'll teach you if you should go on with your company or not. I often hear people say, I have a founder who owns half my company, and I keep working. He's not doing anything. Well, you should walk. You're ultimately doomed if that's the case. So you got to figure out how badly you're getting screwed and see if you can fix the problem. So one of the things that I always tell companies is make sure that the job you're in is going to compensate you the way you deserve to get compensated. If you woke up tomorrow and realized you're not making any money on this podcast, or you're not getting paid in your job where you should be getting paid, you'd quit, right?
Yeah.
So that's you got to figure out. You got to figure out in this very ambiguous time of your life, are you getting compensated fairly? If you're not getting compensated fairly, you got to go out and find a different job or a different opportunity that does compensate you fairly. That's one of the first steps I tell people. And I work with a lot of companies that are in positions that are never ever going to pay off the way they think they're going to pay off. They're just impossible. And I've been in too many situations myself where that's been the case. So now that I know how to assess my own value in the market, I'm much more confident to move forward in startups.
Got it. Man, I again, as I said at the beginning, I love it when we have a player coach, someone who has played the game, scored the points, and also takes the time to share and teach what they know. Let me be the first of many, and I'm sure you've heard it before, but I just want to say thanks for taking the time to share your knowledge, your wisdom, and your insight here with us today at the Cashflow Diary, sir.
Thanks for giving me the opportunity. I love this topic.
All right, ladies and gentlemen, you know what time it is. It's time for you to move at the speed of instruction. What does that mean? That means get over to slicingpie.com. Don't walk, run, win now. Why? Because you know you just heard the concept, the idea, possibly the answer to how am I ever going to get out of my job or make my product actually happen or build this service? How do I change my life? How do I unlock that potential outside of my idea? What can I do with it? Ladies and gentlemen, I know that there's a number of you who have had this question because it's one of those questions we get all the time. I'm hoping that you, like me, you're probably going to re-listen to this one a lot, and that's good. But most importantly, let's take some action. Ladies and gentlemen, it's been fun talking to you today. I look forward to talking to you soon. Until next time.